Most people believe markets reward success and punish failure. That belief sits at the center of how capitalism is sold to the public. Take risks, work hard, innovate, and you win. Make bad decisions, mismanage resources, fail to compete, and you lose. The story feels fair. It feels balanced. It feels logical. It is also incomplete. Because in the modern economy, losses are often absorbed by the public, while profits are kept private. Risk is shared downward. Reward flows upward. And this pattern repeats so consistently that it stops looking like an exception and starts looking like a rule. If you want clear explanations of systems designed to benefit insiders while the public absorbs the cost, subscribe to Insider Expose. This channel exists to explain what corporate language is designed to hide. The phrase socialized losses sounds abstract, but the reality is very concrete. It means when things go well, companies keep the gains. When things go badly, the damage is spread across workers, consumers, taxpayers, and entire communities. The balance sheet shifts, but the pain does not disappear. It moves. This system did not appear by accident. It emerged from incentives, policy choices, and institutional design that quietly favor stability for large players over accountability. To understand how this works, it helps to start with risk. Corporations constantly take risks. Some are productive, others are reckless. Leverage, financial engineering, aggressive expansion, cost-cutting, environmental shortcuts, labor reductions, and complex derivatives all increase short-term returns. They also increase fragility. When these risks succeed, shareholders benefit. Executives are rewarded. Stock prices rise. Bonuses are paid. Careers accelerate. When these risks fail, the story changes. Losses are rarely confined to the decision-makers. Instead, they spill outward. Workers are laid off. Pensions are frozen. Suppliers go unpaid. Customers lose services. Governments step in to prevent collapse. The losses are absorbed socially. This dynamic becomes clearest during crises, but it operates quietly even in normal times. Consider layoffs. When profits fall or forecasts weaken, companies often respond by reducing labor. Jobs disappear. Wages stagnate. Benefits shrink. The company protects margins. Shareholders are reassured. Stock prices stabilize. The cost of adjustment is carried by workers, not executives. Income loss, stress, health impacts, and long-term career damage become private burdens for individuals who did not design the strategy that failed. This is loss socialization at the micro level. Now scale it up. During financial crises, the pattern becomes impossible to ignore. Large institutions take on excessive risk during booms. Complex products generate enormous returns. Warning signs are ignored because incentives reward growth, not caution. When the system strains under its own weight, collapse threatens. At that point, failure is no longer framed as a consequence. It is framed as a systemic risk. Governments intervene. Public funds are deployed. Emergency lending facilities are created. Guarantees are extended. Rules are relaxed. Losses are contained not by allowing failure, but by preventing it. The justification is always stability. The argument is that letting large institutions fail would harm everyone. That may be true, but it raises a deeper question. If failure is too dangerous to allow, why was risk allowed to concentrate in the first place? The answer lies in incentives. During expansion, profits are private. During contraction, losses are shared. That asymmetry encourages risk-taking. It teaches institutions that upside belongs to them, while downside will be cushioned. This is not a moral failing. 'Tis a rational response to the rules. Executives do not need to believe they will be rescued. They only need to see that rescues have happened before. History shapes expectations. Once expectations shift, behavior follows. Risk becomes less frightening. Leverage becomes attractive. Complexity becomes protective. Size becomes insurance. This is how too big to fail emerges. Institutions grow large not only to compete, but to become indispensable. Scale reduces vulnerability. Interconnection creates leverage over policymakers. Complexity makes unwinding costly. Failure becomes unacceptable, not because of ethics, but because of consequences. The system learns to protect itself. Profits, meanwhile, remain private. Even after bailouts, shareholders are often preserved. Executives may face public criticism, but long-term consequences are rare. Careers recover. Compensation rebounds. The cycle resumes. The public pays through taxes, inflation, reduced services, and long-term debt. These costs are diffuse. They are harder to trace. They feel abstract, but they are real. Losses are spread thin, which makes them politically easier to absorb. This pattern extends beyond finance. Environmental damage follows the same logic. Pollution creates profits by lowering costs. Cleanup costs are delayed or externalized. When damage becomes severe, governments step in. Taxpayers fund remediation. Communities bear health impacts. The profit was private. The loss was social. Infrastructure follows a similar path. Companies underinvest in maintenance to boost short-term returns. Systems degrade quietly. When failure occurs, public intervention restores functionality. The bill arrives long after the benefit was taken. Healthcare, housing, energy, and transportation all display versions of this pattern. Private actors extract value during growth. Public institutions absorb shock during decline. This structure shapes behavior over time. Executives learn that avoiding losses personally matters more than preventing losses systemically. Shareholders learn that risk-adjusted returns look better when downside is cushioned. Markets learn to price in support. The result is moral hazard, but not in the simplistic sense. It is not that people want to fail. It is that failure is no longer final. When failure is survivable at scale, risk tolerance increases. This also explains why reforms often disappoint. After each crisis, new rules are introduced. Capital requirements are raised. Oversight is strengthened. Language becomes tougher. Promises are made. Over time, enforcement fades. Exceptions appear. Complexity returns. Innovation outpaces regulation. Memory shortens. The incentives remain. As long as profits remain private and losses are shared, behavior will gravitate back to risk. This is why focusing on individual greed misses the point. Replace leaders, and the structure remains. New people face the same incentives, the same pressures, the same expectations. Intentions bend under pressure. Systems shape outcomes more powerfully than character. This dynamic also affects inequality. When profits are privatized, wealth concentrates. When losses are socialized, costs are distributed. Over time, this widens gaps. Those at the top accumulate gains. Those below absorb instability. Economic volatility becomes a feature, not a bug. The public experiences insecurity. Jobs feel fragile. Housing feels unstable. Savings feel insufficient. Meanwhile, asset holders benefit from recovery cycles fueled by support. This disconnect fuels distrust. People sense unfairness even when they cannot articulate the mechanics. They see corporations recover faster than communities. They see executives rewarded after failure. They see public services strained while private wealth grows. The story of equal risk collapses. None of this means that markets should never be supported. Collapse can cause immense harm. Stability matters. The issue is not intervention itself. It is asymmetry. If losses are socialized, profits should be shared. If failure is prevented, risk should be constrained. Support is guaranteed. Accountability should be enforced. Without balance, the system teaches the wrong lessons. It teaches that scale protects, that complexity shields, that lobbying pays, that consequences are negotiable. Over time, this erodes trust and resilience. True reform would require changing incentives before crises occur, limiting excessive leverage, enforcing real penalties, designing resolution mechanisms that allow failure without collapse, aligning executive compensation with long-term outcomes. It would require accepting discomfort at the top to reduce pain at the bottom. These changes are difficult because they threaten power. They reduce flexibility for insiders. They limit upside, so they face resistance. Until incentives change, the pattern persists. Profits will remain private. Losses will continue to be socialized. Each cycle will feel familiar. Each crisis will be framed as unprecedented. Each recovery will restore the same structure. The system produces exactly what it rewards. This is not a conspiracy. It is design. And as long as society accepts a system where success is protected and failure is shared, the imbalance will continue quietly, predictably, and at enormous scale. Understanding this pattern does not make it disappear, but it makes it visible. And visibility is the first step toward questioning rules that have been treated as natural for far too long.